Have you ever opened up a company's financial report and just seen a giant wall of numbers? Well, what if I told you those numbers are actually telling a story, a really good one, full of drama, debt, and profit? So today, let's dive in and learn how to read the two most important chapters of that story.
Simple. You become a financial detective. And, like any good detective, you need a toolkit. Your main tools, in this case, two documents, the balance sheet and the income statement. Together, they're how you piece together all the clues and really figure out what's going on inside a company.
All right, first up, let's look at our first piece of evidence, the balance sheet. The absolute best way to think about this is like a financial snapshot. It's a photo that captures everything a company owns and owes, but, and this is key, only at one specific moment in time, like, say, midnight on the last day of the year. So to get a bit more formal, a balance sheet really just breaks down three things. You've got assets, which is all the stuff the company owns. Then there's liabilities, which is what it owes to other people. And finally, you have equity, which is what's left over for the owners. It's the perfect summary of where a company stands financially at that one single moment.
Now, this is the heart of the whole thing, this one simple equation. Assets equals liabilities plus equity. Everything the company has, all its assets, has to be claimed by somebody. Those claims come from either lenders, that's the liabilities, or the owners themselves, that's the equity. This equation must always balance. I mean, always. There are no exceptions.
And this slide just breaks it down perfectly. See? On one side, you have everything the company owns, its assets. And on the other side, you have the two groups who have a claim to all that stuff. It's either the creditors, like banks, or the owners, the shareholders. That's it. It's a perfect balance. Okay, detective, let's start the investigation. We're going to kick things off with that first clue, the left side of our equation, the assets. What does this company actually own?
So, assets come in two main flavors. First up, you've got current assets. The big rule here, and our source is really clear about this, is that these are things you can turn into cold, hard cash in less than a year. This includes the obvious stuff, like cash in the bank, but also money your customers still owe you, or all the products you have sitting in a warehouse just waiting to be sold.
And you gotta love the passion on this next point. When the source material talks about things that are like cash, what they call cash equivalents, it makes one thing crystal clear, in all caps, never cryptocurrencies. So yeah, things like gold might count, but crypto, definitely not. Message received.
Okay, on the flip side, you have your long-term assets. This is the stuff a company plans to hang on to for more than a year. So think buildings, big machinery, company cars. This bucket also holds things you can't exactly touch, like patents and trademarks, and this funny-sounding thing called goodwill. That's basically just the extra money a company pays when it buys another business for more than it's technically worth on paper.
All right, let's hop over to the other side of the balance sheet. We've seen all the stuff the company owns. Now let's figure out who has a claim on all that stuff. And that brings us to liabilities and equity.
And hey, no surprise here, just like assets, liabilities are also split into current and long-term. Current liabilities are the bills you have to pay within a year, like paying your suppliers. Long-term liabilities are the debts that stretch out way further, like a big 5-year bank loan or a long-term lease on a building.
So, after you add up all the debts the company owes to outsiders, what's left? Well, that's equity. It's the slice of the pie that truly belongs to the owners, the shareholders. That's why it's sometimes called the company's net assets.
Now, equity has a few moving parts. There's common stock, which is what most of us think of when we think of stocks, but I want you to really focus on that second one, retained earnings. This is basically the running total of all the profits the company has ever made and decided to keep in the business. Just remember that term. It's going to be the key to this whole mystery.
Okay, detective, we've analyzed the snapshot in time. Now, it's time to watch the surveillance footage. This is the income statement. If the balance sheet is a photo, the income statement is the movie. It shows us all the action that happened between two of those photos.
See, the income statement tells a story over a period of time, like a whole quarter or a full year. It starts at the top with all the money the company brought in. That's revenue. Then it starts subtracting all the costs and expenses it took to make that money. And what's left at the end? The famous bottom line, whether the company made a profit or a loss. And this slide kind of shows you the journey. You start up top with total sales, then you subtract the direct costs of whatever you're selling, and that gives you gross profit. Then you take away all the other business costs, marketing, salaries, you name it. And after all that, you finally land on the number everybody really cares about, net income.
And our source material really wants us to celebrate getting to this point.
Net income is the final profit, revenues minus costs and expenses. It's the ultimate report card on whether the company actually had a good year or not.
So, we've seen the snapshot. We've watched the movie. Now, for the big reveal. Because these two documents, they're not separate at all. They are deeply, fundamentally connected. Let's see how it all fits together.
Here it is, the central question of our entire investigation. We have a picture of the company at the start of the year and another one at the end. How in the world did it change? The answer is in the movie, the income statement.
Okay, let's look at a simple income statement here. This company brought in over $43,000 in revenue, spent about $41,000 in costs, and was left with a net profit of $2,358. Great. So, where does that profit go?
It doesn't just vanish into thin air. That profit flows directly from the bottom of the income statement into one very specific line on the balance sheet. Remember that one I told you to keep an eye on? You got it. Retained earnings. And this is where it all clicks. This is the magic. Just look at the retained earnings line. At the start of the year, it was $26,071. By the end of the year, it's $28,429. So what's the difference between those two numbers? It is exactly $2,358, the precise amount of net income from our movie. The profit was just added to the company's savings account in the snapshot.
And that's the whole secret. The income statement is the story. It explains why the owner's stake in the company went up or down. The movie of the company's performance explains the difference between the two snapshots of its financial health. Case closed.
And there you have it. You are now officially equipped with the fundamental tools of a financial detective. You know how to read the snapshot, you know how to watch the movie, and most importantly, you know how they connect to tell a company's complete story. The only question left is whose story are you going to decode next?